Every new business starts in the exact same place. You have an idea in your head, but out in the physical world, there is absolutely nothing. You have zero resources, zero cash, and absolutely no momentum. To turn that idea into a reality, to hire a team, build a product, and actually survive, you have to move. And movement requires fuel. You need capital. The moment you decide to go get that money, you hit a strict fork in the road. You must choose between two paths that head in entirely opposite directions. This diagram outlines your options. Down one track, you have bootstrapping, where you rely completely on internal self-funding. Down the other track is venture capital, where you trade pieces of your ownership to outside investors. Your choice of capital locks you into a specific set of physical rules. It dictates how fast you have to travel, the pressure you will face, and the ultimate trajectory of the business you are trying to build. Let's follow the first path. A bootstrapped founder works completely independently. You are alone in the workshop, building the initial product with whatever savings you have in your own bank account. The process relies entirely on the business's own generated revenue. You make a sale, you take that small profit, and you put it right back into the company to fund the next step. It is a deliberate, methodical crawl. This chart shows the economic payoff of self-funding. You hold the entire pie. You retain absolute decision-making power and all equity. But holding that block imposes a strict speed limit. Looking at this timeline, your expansion is rigidly capped by organic sales. Day to day, this means laying tracks 1 inch at a time. It is a grueling, brick-by-brick build where you only spend what's earned. Because of that careful pacing, your daily existential risk is relatively low. There is no board of directors demanding you triple your headcount by next quarter, and no external financial pressure forcing you into hasty expansion. You guarantee your total autonomy, but the trade-off is velocity. Surviving on this track isn't about moving fast. It is a brutal test of extreme patience and endurance. Now look at the second track. Venture capital operates in a completely different, high-stakes environment where isolation is immediately replaced by external fuel. The visual here shows the core transaction. You are trading away large chunks of company ownership for massive amounts of cash up front. But watch the graph. This cash acts as a hyper-growth mandate, a contractual obligation to push your company up a steep exponential curve. This massive influx of capital forces you into an immediate sprint. You have to hire faster, build faster, and aggressively capture market share before well-funded competitors do. To maintain that unnatural speed, you have to intentionally spend cash much faster than the business actually earns it. You are burning millions a month just to keep the engine running at maximum capacity. Investors demand this behavior because they are looking for a very specific outcome. You have to reach a massive, industry-dominating scale so they can secure a return on their investment. If you fail to reach that scale before the external cash dries up, the alternative is rapid, catastrophic failure. There is no middle ground. Taking venture capital physically rewires your company's DNA. It turns a standard business into a high-risk financial instrument, one engineered exclusively to scale or fail. When we zoom out and look at these two paths side by side, we see two completely divergent endpoints. Neither model is right or wrong. They are simply economic tools, engineered for different operational goals. The bootstrapper finishes the race owning 100% of their company. It will likely be smaller, but it is highly stable, debt-free, and deeply resilient to market shocks. The venture-backed founder finishes holding only a tiny fraction of their company, but that fraction might be a piece of a multi-billion-dollar high-speed empire, assuming it didn't collapse along the way. As a founder, you have to choose your capital carefully, because the specific type of money you accept on day one dictates the exact race you are forced to run.